Mikhail Midan, head of the China Energy Research at the Oxford Institute for Energy Studies, and Amina Bakr, senior research analyst at Energy Intelligence. Thanks so much, everybody, for joining us. Dr. Mikhail, and I hope I'm pronouncing your name correctly. Let's start with you because we do, China is very much center of mind, isn't it, for this oil market? It always is, and even more so as its economic picture continues to sort of change, quite dynamic. We, of course, had China itself announce its expectations for economic growth early this week, so for the year. So give us your take on how much the oil market is pinning its hopes, obviously, and believing in this growth trajectory, even at 5% for China.
I think we always have an issue with the mismatch between market expectations and reality, right? There's still these, I guess, desire for a stimulus, or for somebody in the Chinese government to say a stimulus is coming and China is going to, boom again. That was never in the cards, and that is not in the cards. I don't think there was much sort of different to expectations, right? We thought we would get 5% GDP growth target. Not too much of a loose sort of fiscal stimulus. We did see kind of local government debt, the kind of funding vehicles being a bit increased to suggest that the government wants to support growth, that it is still going to work in sort of very measured incentives to continue supporting growth like it did last year. Now, what we don't have this year is the post-COVID rebound. But again, I think the expectation of slower demand growth from China was baked in. Where I think the market is nervous and jittery is that there is a lack of confidence in China because of the real estate downturn and because of simple things like cancelling the premier's press conference. And I think that is sort of rattling markets because they just don't know how to interpret the signals that are coming out of China anymore. And even the kind of 5% GDP growth and the growth targets, last year, there's a lot of skepticism about whether China really met it really met the 5.2% GDP that it said that it achieved. And I think there's a change in the structural drivers of China's economy, and therefore of energy demand growth. And that has left markets a bit confused about, is this real and where is this really coming from? And that will remain part of the story for this year as well.
Okay, thanks very much. Amina, good morning. Let me go to you with that and talk a bit about the suppliers to China. And of course, OPEC and its producers are big suppliers there. Let's get your take first on what you think of their announcement earlier this week about the cuts being extended through to June, and how much is the China factor, do you think, factoring into their decisions much more than before? Perhaps is there concern there in the demand equation?
Good morning, Diala. Yes, very important question here. I think the main factor they're looking at, and a lot is riding on demand this year. And that's the kind of reasoning behind their decision last Sunday to extend the cuts, the voluntary cuts, which are around 2.2 million barrels a day, for another quarter. So these cuts are going to last until the end of June. The group is expected to have an official in-person gathering in Vienna on the 1st of June. So they will be discussing these voluntary cuts and further supply policy. But the fact that they extended the cuts was expected because there are still a lot of uncertainties around demand. The fact, Diala, that we have these huge discrepancies over how much demand will grow this year. You have forecasts from 1 million barrels a day up to 2.2 million barrels a day. But in any case, if you pick any of these numbers, most of this demand growth is expected to happen in the second half of the year. So I think OPEC, or those 8 producers that decided to extend their voluntary cuts, are taking the cautious path. They don't want their grip on the market to slip. We can see that Brent is very much still supported. It's trading around $82. We're expecting to see it around that range. But the story of this year and the main driving factor is demand.
Okay, thanks, Amina. And Brian, let's go to the US then. I know that China obviously is a big demand center, as is Asia. But what about the US picture in terms of demand and growth? Because, still looking pretty good, the economy, But there are some comments beginning to creep in that, putting aside the stock market hiatus on these tech stocks, that really think, we are in the second half of this year going to see a sort of shallow recessionary indicators in the US economy. And is that the feeling you're getting, or is it not?
Well, I may be a little bit of a contrarian, but we've been hearing about recession for the last almost 2 years now, and it just really hasn't shown. And part of the reason it hadn't shown is because of new debt creation and there's a lot of inflationary pressures. Quite frankly, it's an economy that is driven by the fiscal policy, and with the fiscal policies, there's a lot of pressure coming down for this year for rate cuts, and that adds extra support to the oil price, which will foster maybe some continued development on the oil and gas resources. We've seen tremendous growth on crude oil and natural gas, but a lot of that has been fueled by tripling our rigs from 2020 to 2023. So we tripled our rigs and we grew by 18%. So a lot of that, when you step back and pull it apart, I don't think when we look around the world that the US economy is going to rise or fall. All the economies, quite frankly, it's going to rest on China, it's going to rest on India, it's going to rest on developing economies. And when you look at the supply pipeline and the demand pipeline, all the eyes are on demand, because there's real concern that if the economies, the consumer economies like the US, start slowing down, that's going to spill over to China, and that's going to spill over. Well, India is kind of a newcomer, and that's going to be an interesting story, I think, over the next 24 months.
Okay, thanks, Brian. Dr. Michel, just back to China in terms of its consumption of crude and imports there. I mean, the prices have been pretty range bound, $80, relatively cheap, at least within China's acceptable range of, yes, it still buys at that price, being quite price sensitive. What's the expectation on whether, given its economic outlook, it'll be stocking up a bit more on crude? I know we don't have any official figures always, but how is it going to, do you think, look towards the year in terms of crude imports, product exports, given the quotas that have been set by the government, etc.?
I think the crude import growth is going to be a bit more muted than in previous years because of limited stockpiling. I mean, it's a question of price. It's also a question of forward cover, and China probably has roughly 80 days of forward cover now. So it does mean that there are still stocks to fill, both strategic and commercial, but there's limited urgency to do so at higher prices. Now, 80s are still acceptable. We do have refineries starting up. We've got chemicals facilities starting up this year. So that does call on commercial stocks. I think that will continue to drive the crude complex and Chinese imports. I guess two things that will slightly dampen the outlook or will change some of the dynamics is sort of alongside what we were talking about in the growth imperative and the government sort of wanting to protect growth, but not a stimulus at any cost. We are seeing, I guess, the kind of policy pendulum shift towards greater environmental protection. We're at the half point of the 14th five-year plan. China isn't on track for some of its energy and climate targets. And so there is a crackdown on energy intensity. There's a need to be more mindful. Usually in the oil market, the first port of call for that is the independent refiners that get tax crackdowns, environmental inspections. That means less crude from them, and typically less Russian crude from them, which could actually be good news for the Middle East producers. The environmental move also suggests that we're likely to see less growth in product outputs, in product exports, that the kind of quotas are going to be capped. Now, unless we get a rapid deterioration or a sense in Beijing that they need to protect economic growth through sort of an oil-related stimulus, and then we're going to see more quotas later this year. That's currently not the trajectory, but unless we see something like that, then oil product exports are actually going to be limited. I think it's the chemical markets that are becoming very oversupplied, and other energy sectors where the overcapacity from China is really going to be a big problem this year.
Yeah, and there were some comments this week from some of our guests on that there's good sort of premiums on products at the moment in Asia, and so China may actually be delaying some of its maintenance in refineries to sort of take advantage of those exports. But I suppose it's a step-by-step process. Amina, let's go back to you and talk a bit about competition and market share. We had last year probably some concerns within the OPEC Plus group and by Saudi, particularly about rising US production. Most people are saying that's going to plateau or kind of remain as is. But how important is that a factor in OPEC's thinking? Do you think as it goes towards its June meeting, it's going to be setting new quotas for its individual members? They've managed the market well so far, but is that becoming an increasing challenge?
Well, I think the increasing challenge is how to unwind these cuts, Diala. That's where they're going to face the most in terms of their challenges. Of course, growth of supply outside the OPEC Plus group remains something that they're keeping an eye on. Growth from the US, we're seeing the potential from Brazil, Guyana, from other areas. So all of these supply pressures that are coming from outside the group is something that they are keeping a track of. But for the time being, I mean, they're favoring the policy of keeping kind of a tight grip on the market in terms of management, knowing that the price is going to be within a certain range, making sure these stock levels remain under the 5-year average. But when it comes to the unwinding of the cuts, our understanding so far is the way that they're going to happen is that you have various tranches of this agreement. You have the voluntary cuts by the 8 members, which is the 2.2. You have the group cuts, which is the 2 million, which is placed until the end of this year. And then you have another voluntary cut that's 1.6 million by some members that, again, is until the end of this year. So the first tranche that is going to be unwound is the first 2.2 million barrels per day by the 8 members. And that most likely is going to come gradually into the market on a pro rata basis. Doesn't mean that Saudi Arabia gets, to put all of its 1 million barrels a day into the market, even though they have been consistent and they're the biggest producer. I mean, they're the ones with the biggest cut in terms of allocation, but doesn't mean that they're bringing it back first or all at once. So again, gradual process. Again, another challenge I think for them in this kind of environment is compliance. I know that we saw various members, Iraq, Kazakhstan, Russia, saying that they're going to be sticking to their quotas. But in this kind of environment where you have a price band of $80, it's tempting for some of these members to start overproducing. I mean, that remains to be seen. We have the secondary source numbers to revise every month. But I think that is another challenge for the group.
Okay, thanks. Just to go back to you, Dr. Michaela, on the sort of Russian crude side, we did see a lot of Russian crude going to China, and we still do, I suppose, and India last year. With the discount slightly changing there and narrowing, from the evidence or talk that you've seen, are we expecting China to continue to do that? Or, what do you think will happen on that front in terms of, taking Russian instead of Saudi crude, for example?
The discounts obviously are a big factor and they remain appealing, but I think we have to note that most of the uptake in sanctioned Russian crude, has come from the independent refiners, from Shandong, where it's not just about Russian crude discounts, it's the competition between all sanctioned crudes, right? Iranian, Venezuelan barrels and Russian all compete for the Shandong, the independent, sort of the teapot market share. Now, if they're going to come under tighter control and supervision this year, then that's one chunk of the market that will be harder, that will be less accessible to Russian crude. And so I think there is going to be a slight shift there. Add to that the fact that it is harder to get Russian crude, that the bigger Chinese traders do not want to expose themselves to secondary sanctions or to any kind of issue that will impede their ability to trade in the global market. So I think there is sort of a little bit of a bright spot for Middle Eastern crudes in China this year.
Okay, and they continue to adjust their OSPs, don't they, according to what else is coming that way. Brian, let's talk about just touch on the Venezuelan crude story, because from a US point of view of sanctions and that reprieve that was given for 6 months, which of course is up for expiry or renewal in April, we've had different schools of thought on that. Some people saying they don't think it'll be extended, and others are saying no, the US needs to keep its gasoline prices and everything else in the world under control. Let's keep that oil flowing. What would you expect to happen given we're in an election year, etc. as well?
Well, you know what? I made a big mistake by being in the energy industry because I didn't want to get into politics, but energy drags you kicking and screaming into politics. So I think your last point of it being an election year, I don't see. I see some fostering of continuing that support of bringing Venezuelan crude in, because as much as the United States is producing 13.3 million barrels a day, we're exporting 4.7. And the reason that we're exporting close to 5 million barrels a day, which is a significant portion of the 13.3, is because our refineries aren't built for the type of crude that we're actually producing in the United States. It's a lighter crude, and it doesn't give us the blends that the refiners in the US are looking for. Venezuela, Guyana, these have good types of crude, and a lot of our refineries were built on some of the Venezuelan crude. And so fortunately, they've changed over some things on the refineries, tuned some things to the mix. I don't see Venezuela making a huge splash on the supply side in the next 12 months. But probably in 24 months, I see that being a much bigger part of the portfolio. But I see anything that keeps prices down during an election year as being a policy-driven event, with the exception of what the doctor was referencing on some of the environmental policies, which are also weighing down on a lot of operators in the United States. I mean, there's some statistics out there that are quite frankly on some of the emission standards on methane that could really undermine a lot of the production in the United States. And that would actually change things significantly. I think when push comes to shove, we're going to want that economic engine up. So some of these policies are going to be walked back a bit. So that's my non-political
that certainly seems
commentary.
to be a pattern, actually. And I wanted to go to maybe to Dr. Michal later about talk about European majors sort of backtracking a little bit on those green commitments of investment. There's our survey question for today. China has targeted economic growth of 5% this year. Will that be bullish or bearish for oil prices? Is it enough or is it within expectations? Amina, let's talk a little bit about sanctioned oil, but Iran, because we seem to be talking a lot less about Iranian oil the last few months. We're talking about Iran in a different context, maybe. But the Iranian oil story that last year was a bit of a story, more oil coming on, being being allowed to be on the water by US sanctions and turning a blind eye to that. Is that continuing? Is that the indication we're getting from what you see?
Yeah, that's very much still the case, Diala. I think the Iranians have managed to secure their exports through mechanisms that are still they are still under sanctions, but they are bypassing these sanctions. They are still exporting into China mainly, and what the doctor said about, a lot of these sanctions crudes making it into the teapot refineries in China. A portion of that are still Iranian crude. So I don't see the tightening or the announcement that was made by the US, especially following what happened in Jordan with the killing of a number of US staff, and then the president coming out and saying that Iran was behind it and they were going to be tightening sanctions and there are consequences. Following that, we haven't really seen any changes on the ground to suggest that Iranian exported barrels are in danger.
Okay. Dr. Michal, let's get your point of view from a sort of geopolitical angle, from a China sort of geopolitical angle, in terms of how concerned do you think it is getting about the Red Sea events, obviously the whole regional mess of geopolitics that we're seeing at the moment, but from a sort of energy supply security point of view and from an involvement point of view geopolitically, would it start to want to weigh in to the talks, the behind the scene talks, for the sake of its energy security? I mean, where do you think China stands today on that? Or is it too distracted by domestic economy?
It's a great question, Diala. I mean, I think certainly the domestic economy is front and center for the Chinese leadership, right? It's more often than not, and I think it's true for all politics. All politics are local, right? And they're domestic and about keeping the picture stable. The Middle East has always been, of course, the biggest supply source for China, and therefore a big concern as it regards to energy security. And I think there's a difference here between perceptions and reality. It's been interesting to see over the years how China has really tried to cap the share of the Middle East in its energy supplies, and it really continues to hover at around 50%. Now, when you compare that to Japan or other Asian exporters where you've seen, Middle Eastern crude, Middle Eastern oil really rise as a share of total imports, China has managed to cap it. Now, of course, that's the share. Absolute volumes have increased and continue to grow pretty rapidly, but there has been a concerted effort to diversify sources of oil and to sort of mitigate those risks and those vulnerabilities. You add to that, again, the forward cover, the SPR, and all of those things. It does give China a little bit of a hedge in reality. Now, the perception is still that there are vulnerabilities. The Middle East is insecure. The Red Sea is an issue, but I think because the market isn't extremely tight, and we've seen this, prices haven't reacted too much to it. They're still monitoring it with concern, but there are kind of workarounds that still operate right now. We haven't seen the Chinese get too involved in trying to secure the Red Sea and trying to calm tensions on that front, other than sort of boilerplate announcements. But those boilerplate announcements in China's position has really skewed to the I guess, an anti-US position. Whatever the US says, we'll say the opposite. And I think for the long term, it's playing in China's favor as, a good partner for the global South, and it is expanding its relations with the Middle East beyond beyond oil to energy and e-commerce and other areas very successfully, but on sort of geopolitical mediation. And of course, we saw China brokering the Iran-Saudi deal last year. I think that was more of a symbolic win than an actual sort of diplomatic move that took that required sort of costs or some kind of big sort of penalties from China. And I think they're still happy to, as much as they can, keep it rhetorical, keep their support rhetorical. They are watching with great concern, but again, I think they're more sanguine than they used to be about energy security, especially as oil demand is about to peak. Sort of for anything but chemicals, certainly gasoline and diesel, they're likely to peak in the next couple of years. And again, that adds to China's slightly less, I would say, sort of panicked response to the situation.
Thanks, Dr. McCann. Brian, let's quickly just talk about LNG, because we had obviously an announcement by the US last few weeks about its sort of pausing LNG exports. People have said there's no problem with that because we have plenty of LNG around, don't we? And look at the gas prices. The trajectory for sort of gas as we go forward this year and LNG exports from the US, any concern that it may lose its competitive edge a bit if it pauses these exports, while countries like Qatar, Australia, etc., and Saudi now announcing new gas reserves, where's the US thinking on this?
So when you talk about LNG, there's a lot of different facets and a lot of different components. From the policy side of the equation, what was paused was kind of future development. We have a pipeline of construction that is in process that'll be coming on in the next 16 months. And from everything that I've read from a policy and a regulatory oversight, it's not going to hold those up. And so we're going to have a significant go from, say, 14 BCF a day up to just over 20 BCF a day in the next 16 months. You add into that that Canada has a very large 2 BCF a day LNG export that is going in the next 16 months. Mexico is having another one. So North America is actually going to be a very, very big exporter. And if you dial the clock back 10 years, I mean, it was pretty much Qatar and Australia. And now the United States is now a very big player. And when you talk about LNG in the short term, in the next 12 months, some of our clients have been asking, well, with the warm winter in Europe, are we going to have some cargoes shipped back to the U.S.? And I said, well, as long as you have conflicts around the Red Sea, some of the sanctions, some of the ship problems, they're not going to turn back LNG from U.S. because that's going to be seen as more stable supply right now. If there is peace, that is going to be something. But if you also pull back the lens and take a look at macro LNG dynamics, we're likely going to be oversupplied sometime in 25, 26. But then in 27, the regasification catches up across the globe, and we're going to be back to being short. That's when the LNG pause is going to come into effect, because the next wave was anticipated for 2030, but many of the international buyers of LNG are now unsure whether or not they really want to take more from the US, because is that going to get built? Am I going to sign something that is really going to happen or not?
Uncertain, exactly, especially Europe, which is obviously building up its independence from Russian gas. There's the question answer. Bullish gets a slight blip, 58%. So that 5% target is being seen as bullish, i.e. better than expected, possibly. But then again, that could, of course, very, very quickly change. Amina, I'll go to you to wrap up for us. I mean, Brian just mentioned shipping, the disruptions to trade flows that we've had in the Red Sea, which nobody is saying are going to stop anytime soon. I mean, from a volatility point of view, what are OPEC members expecting? Are we going to have a more volatile year in terms of trying to manage those prices and balances, or less? More black swans, more geopolitical uncertainty, or more certainty now that we know that China is growing at 5%, and we're kind of 2 years into the Russia war, etc. So more or less nervousness from oil producers, do you think, this year?
Definitely there's volatility, Diala, but just observing this market today, I can tell you that, I don't know, 10, 15 years ago, if you had the same events happening in the Red Sea, you would see oil prices hit above 100. We're dealing with a completely different market that is kind of not reactive to these kind of geopolitical risks in the Middle East. Just one other point. I mean, yes, the Houthis have been undergoing attacks almost on a daily basis. There's no sign of them stopping, and they're not targeting. I mean, we've seen the targeting of various ships, sometimes owned or cargoes owned by Gulf producers in the region, and not just Western producers or producers or Israeli-owned vessels. So they're targeting everything at this point. And despite this, we haven't seen a significant supply disruption, and this is perhaps why the market haven't reacted. I think that the market is underestimating the geopolitical risk to some extent. It's something that Gulf producers here are keeping an eye on. Of course, this is in the background, but I think the biggest story for this year remains to be demand and the recovery of China. That's what's going to be leading policy for 2024.
Okay, thanks very much, Amina. That is a statistic on the Red Sea passage, 12% of total seaborne trade, but 7 million barrels a day only of crude and products in terms of the total. So perhaps that's another reason why we don't see too much of a panic yet, and obviously no real disruption. Thanks so much to Amina, Dr. Miqdad, and Brian for joining us this morning, and have a great remainder of the week. Thanks, everybody.
Thanks
Bye.
so much.
Bye.
Thank you.